Most marketing agency owners are leaving a lot of money on the table by not analyzing their agency's profitability properly. When you first start your agency, the number one thing you focus on is getting clients. So when that revenue number starts going up, you start to feel like you made it. But as you go from 10K months to 100K months, you start to accumulate expenses, and then profitability starts to matter more than just revenue. Now, I'm a fractional CFO, and our accounting firm works with 7- and 8-figure e-commerce brands and marketing agencies. So in this video, I want to give you a short but dense overview about how you can be looking at your agency's profitability to make sure you're actually making money. We'll start off at the top really simple and then get more complex as we go. So at the top of your profit and loss statement is your revenue. This is that number that most agencies like to multiply by 12 when they have a really good month so they can seem bigger than they are. Now, most agencies know their revenue number. That's kind of straightforward, but to take it a step further with your analysis, you want to split it by service line. So say, for example, you run a digital marketing agency, you might have a line for Google ads, for Facebook ads, and for email marketing. Clients will often buy multiple services, so you want to break up the pricing based on the proportions of what you would have charged them if they had bought a single service. Now, there aren't any strict rules about how you want to break up your different service lines, so you can apply a little bit of judgment here. But as a rule of thumb, any service that can be purchased separately should have a separate line, or if it can be done by a completely different team. This will also make it easier as you scale to think of your agency as having different departments. Now, looking at revenue is great, but there's actually a lot more depth to how you can analyze that number, so we'll go through a couple of ideas. You can also look at your revenue by client. This is very helpful because it can give you an idea of whether there are certain clients that are carrying your agency or if you just have a large volume of low value clients. It also helps you identify if there might be a client on which you have an economic dependency. For example, if there's one client that's more than 30% of your revenue, you have to be very cautious when you're making scaling decisions, because if you were to lose that client, it could trash your agency. Another way to look at your revenue is comparing the base fee versus the performance fee, assuming you charge for performance. This can help you understand how much of your revenue comes from actually doing good work and scaling accounts, so basically the performance component, and also lets you know how much risk you have if all of a sudden the performance goes down and you're relying just on your base fees to pay your bills. And lastly, any one of these analyses can be done on a time series as well. What that means is looking at the data over time. So for example, looking at your revenue by client by month. This is very helpful because it can make it a lot easier to identify why revenue is going up or down. You can more clearly see how much of your revenue you're churning, how much new revenue you're adding, and how much of it is coming from recurring clients that you're retaining. Alright, so revenue is all well and good, but you can't scale without adding more people, which brings us to the next major category to analyze, which is your cost of service. Here you want to track the costs that are directly associated with what clients are paying for. The two major categories that are most commonly found here are going to be your personnel and software. But remember, it only includes the personnel and software that are directly related to delivering the service. So for example, a media buyer would go here, but not your salesperson. You want to look at these costs separately because they give you an idea of how much it costs to be able to generate that revenue. Meaning if you were to double your revenue, generally you would also double your cost of service. Whereas the amount that you're paying for your CRM or for rent generally won't increase quite the same way. Once you know your cost of service, you can deduct that number from your revenue to be able to get your gross profit. And then that number divided by your revenue is your gross margin. These numbers are incredibly important to pay attention to because they're one of the core measures of profitability for your agency as you scale. If you don't have great operations or processes, then your margins will typically get worse as you scale. The more clients you add and the more your revenue goes up, the more people you're going to add to the team, and then things can get a little bit messy and inefficient. So you want to keep an eye on this number to make sure that as you continue to grow, you're not actually hurting yourself more than you're helping. If things are consistent, then your gross margin percentage should remain the same even as revenue goes up. So for example, if I have $100,000 of revenue and $50,000 for my cost of service, that gives me a 50% gross margin. If my revenue doubles to $200K and my cost of service doubles to $100K, I still have a 50% gross margin. A good gross margin for an agency really depends on the type of service you're providing as well as the level of growth you're at, but generally speaking, you're looking at something between 70 to 90%. And if you get really advanced with your analysis, you should be able to look at your gross profit and gross margin by department or service line, as well as by client. We'll dig into some ways that you'll be able to do that analysis later in the video, but understanding your profitability by client is one of the most useful things to know when you're growing an agency. Next up, you're going to want to look at all the other expenses that you have in your agency. Depending on how virtual you are, these can be relatively minimal, but they can add up over time, so you want to pay attention to them. So this will include general software like Slack, ClickUp, or Pipedrive. It'll include personnel that are focused on either accounting or operations or sales, and other stuff like your marketing efforts, computers, your website hosting, basically everything that's not directly for a client. Once you deduct your expenses from your gross profit, that'll give you your net profit, and dividing that number by your revenue gives you your net margin. Now, the simplest way to look at this is that if your net profit is positive, that means you're making money. If it's negative, it means you're losing money. What's more useful though is your net margin. So basically, of all the revenue you collected, how much profit did you extract from it? Now, this number can vary a lot depending on your strategy and stage of growth. Early on, when you're the only person in the business and you're doing all the client work, your net margin can be over 90%. As you scale and add more people and pay them to do the work, it's naturally going to come down. Early on, when you add on new service lines or new departments, usually they're not going to be quite as profitable beginning, so that's also going to drag it down until it goes back up. And if you're reinvesting a lot of the money you're collecting into sales and marketing, then that leaves very little for profit, so your net margin is going to look lower then too. So an agency that's growing rapidly might have a net margin closer to 10%, while one that's a bit more mature might be closer to 40%. So what's a good number will change depending on your strategy. So now you have your full profit and loss, and before we go into a little bit more depth of analysis, there's two main ways that you can look at the statement as a whole. The first is horizontal analysis. This is basically where you look at your profit and loss month by month, side by side, to see how numbers are changing over time. The second is vertical analysis, where you look at each line as a percentage of revenue to see how much of your total revenue is going towards that particular expense. You can also combine these to look at an expense as a percentage of revenue over time. So for example, my personnel cost used to be 30% of my revenue, and then all of a sudden it started going up to 40%. That might be an indication that you need to dig into things. So now that we have a high level overview of how to handle this for an agency as a whole, let's go into a little bit more depth. When you offer multiple services, looking at the profitability for each department or service line separately is very valuable. For example, let's say your profitability by department looks something like this. You may look at this and think, oh, Google's my most profitable service, so I should put all my effort there. But you also know that Google benefits a lot from the work that's being done on the Facebook side. So a different way to interpret that is that Facebook is actually your core service that's driving the growth and the client value, but Google's just a really solid add-on that's quite profitable. Now, email marketing, on the other hand, that might be a distraction. It is still bringing in some gross profit, and at the end of the day, it's more dollars that you have available, so that's a good thing. At the same time, you might want to consider whether or not that department's a bit of a distraction. If you yourself are very involved in the work of the various departments, and because of the fact that email's there, you have to spend a bunch of time on trying to figure out how to make that work, which means you're spending less time on Facebook and Google, then it might not necessarily be worth keeping. Or if it just so happens that you very rarely cross-sell the Google and Facebook services to email clients and vice versa, and they kind of have their own separate sales pipelines, then you also have to consider whether or not it's worth putting all that effort into getting more email clients. At the end of the day, there are multiple ways to interpret this information, but the point is that if you have it, you can make better decisions. You also want to consider how you want to treat the admin expenses. Now, admin expenses that are directly attributable to a specific department are easy enough to track. Say, for example, your email team is all contractors, but your Facebook and Google Ads teams are all employees. So all of the costs that you incur for payroll processing, those administrative costs should be applied to Google and Facebook, but not to email. However, some of the expenses are a lot harder to analyze that way. For example, all your costs for marketing. At this stage, you usually have two approaches. You can either look at all of your administrative expenses separately as if they're in their own department, or try to attribute the administrative expenses to the various departments. So for example, do you just look at your marketing expenses in isolation and look at the total revenue that you're bringing in, or do you try to attribute those marketing expenses to each department and try to find how much revenue you're getting for each of those expenses? While the latter is probably a little bit better an approach, it's also rather complicated. So for most agencies, I'd say just focus on the former way and look at your expenses that are administrative separately. All right, so we've looked at our profitability by department, but we're scaling. So let's go even deeper. If we have a large department with a lot of people, then how profitable are the people inside the department? So in the simplest scenario, you can look at this at the employee level. This works especially well if one employee can provide the entirety of the service to a client, though that's not always realistic. So for example, say you have a junior PPC analyst, they cost you $4,000 a month, but they are able to manage a revenue of $12,000 a month. That $12,000 of revenue divided by $4,000 of cost gives you a multiple of 3x. So if you have a team of people doing very similar work like that, you can compare from one to the next to understand if any of them are at a lower multiple. If that multiple is lower than your target 3x, that either means that the person's not being that efficient, or that you might not be charging enough to the client for the amount of work that it is. Either way, looking at those multiples can be a red flag for you to identify where you have profitability issues. Of course, like we said, usually a client's not working with just a single individual, so another way to look at it is in terms of pods. So a simple way to think of pods is, say for example, you have one Google Ads manager and 4 staff that work for that person. Each staff might have, say, 5 to 10 accounts that they deal with, but the manager oversees all of it. So in this situation, you might see that each staff has roughly $16,000 of revenue, but the manager doesn't have any revenue of their own. As a whole, though, you would combine all the revenue of all the staff in the account, as well as all the costs of all the staff plus the manager. So in this example, that would give you $64,000 of revenue and $23,000 of cost for a 2.8x multiple. You can still look at the multiples for each employee within a pod, but this also allows you to compare from one pod to the next. If you see a particular pod that has a bit of a lower multiple, you can dig in and find which employee has a lower multiple that's dragging it down. But let's say for a department like Facebook ads, the work doesn't divide up that cleanly. A pod might include a creative strategist, a graphic designer, a media buyer, and a copywriter. Each one of them doesn't have their own revenue because the client's not paying for each service separately, they're paying for the full package. Now you can still look at this on a pod basis to see the total revenue the pod generates and their total cost to come up with a multiple. However, if the multiple is lower than you'd like, it's a little bit harder to know which client or which individual is the one that's kind of dragging it down. You should still be able to talk to the team because they'll usually have a sense of which client is the one that's being a drag on their resources, but it's not as mathematically easy to identify as in the previous example. And to take it one step further, if your team happens to use time tracking, then you can use their time spent on each client to identify how much of their costs should be attributed to each client. That way you can get a really good sense of how profitable each client is and whether or not a client is worth keeping or if you have to increase their prices. With these sorts of approaches to analysis, you should be equipped to get a much better sense of your agency's profitability. That being said, being able to do an analysis like this means that you need to have very clean data to work with. So if you need any help with your agency's bookkeeping, or if you're getting a little bit larger and want some CFO level support, feel free to reach out. In the meantime, you might also enjoy this video on how to choose the right services to scale your agency. But other than that, thanks for watching and I'll see you next time.